day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, let's take a look at the disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, like all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Great. And today we're going to be talking about option gamma hedging strategies.
Yeah, and mostly about just explaining option gamma, and it came because of a question that came through the email, and it was a question, but it had to deal with option gamma and all these different scenarios, like changing dates, stock moving around, and it's a good question. It's an important question, and I think that I'm going to try to describe option gamma in the simplest way I can. Okay, what it is and why it's important to traders, how to use it, right? Like why do traders even care about the option gamma, and how can it benefit you? Okay, so first, let's go to an options chain just to kind of look at the options and explain this important option Greek. Okay, it's an option Greek which measures the sensitivity of an option value. Okay, so let's go to Netflix, for example. And we'll start out by, let's go to an options chain first, okay? And what we're going to do is start out by first thinking like, okay, as a trader, if I have a position, I have a risk position on, let me click on this menu to expand it. I have a risk position on, and it's important to understand what is my risk? Like what is my risk based on certain market dynamics or changes in the market? Like when we say risk, well, when we mean, well, if this happens, what do I risk? Or if that happens, right? So we were asking all these different questions. How sensitive is my portfolio to a change in something? So for example, if you have a stock, let's say Netflix, well, it's pretty straightforward to know your risk. If you buy 100 shares of stock in Netflix, if it moves up $1, you make $100. If it moves down $1, you lose $100, right? So when it's very straightforward for to calculate your risk, right, of a movement in the stock. Moves up $2, you make 200. If you own 1,000 shares, it moves up $1, you make 1,000. If it moves down $1, you lose 1,000. So that's simple, right? We can do that in our head. However, with an option, it's not that simple or straightforward. And options have different factors in it that could impact the value, right? Stock movement, implied volatility, all these different factors that, interest rates, goes into an option pricing model, and the option price could change when any of those parameters change. So you have these risk sensitivities to different factors that go into an option price. And when we look at an option price, like here, we're looking at all these different options, right? So Netflix over here has all these different strikes. You have calls, you have puts, you have strikes that are way in the money. Like, so let's say if we have a strike of 1,000, right? Well, Netflix is already 1,180. So this strike is in the money. The stock is already at $180 above that strike, right? It's already, it's that option is in the money. It's not worthless. You could buy it, that option, and if you exercise it and you're buying it for, by exercising this option, you're buying the stock for 1,000, but it's already $180 in the money. So it has to be worth at least 180 or 180.37 cents. So that option's in the money. But then you have these options that are way out of the money. All right. Now you have these options that are, let's say, I'm going to come out to here, 2,660. Well, you're not going to buy that call and exercise it, because what would happen is, if you exercise it, you end up buying the stock for $2,660. But why would you buy for $2,660 if the stock is already below that 1,180? So you don't need to exercise that call. So the point here is that an option could, the option value of a call could be anywhere from a 1 delta to a 0 delta. Okay, so that's how deltas work. It could be from a 1 delta to a 0 delta, meaning a 1 delta or 100 delta is that the option deep in the money will move with the stock 1 for 1. So if the stock goes up $1, the option is expected to increase $1. If the stock goes down $1, the option is expected to decrease by $1. But that's not the same thing here, right? Like, even if the stock, if you would look at an option with 2,660, even if the stock goes up $1, it's still way, way out of the money. First of all, this option is a penny, so the most it can't go down more than that, right, to 0. So if the stock goes down $1, it won't impact that option price, and even if it goes up $1, it's not going to impact this option, because it's still way, $1 move means nothing, is not meaningful in this situation. We're way away. So that's the delta of the option. So, and why is it important? Well, when we look at all these options, right, they're all a derivative. They're all tied to a movement in the stock. So if the stock goes up $1, all these options, they're going to move differently. Okay. Now, they're not all going up by $1 or down by $1. That's not how it works. They're going to move differently. Some may move $1, some may move 50 cents, some may move 10 cents, some may not move at all. So they all have different risk sensitivity to a dollar move. Okay, so and the way the Greeks are created is it's pegged to a dollar move in the stock. How sensitive are these options to a dollar move? Okay, and it's important to understand those option dynamics. What are we expecting the option to move for dollar move in a stock? And that's, and when we measure these Greeks, keep in mind that these are all estimated moves, because markets are dynamic, implied volatilities can change, interest rates can, time passage. It's just looking at if everything else is constant and all that happens is a dollar move up or dollar move down. That's what we're trying to figure out here. And it's important for hedging purposes as well, because think of it like this. If you let's say you have these option, before I get to the gamma, it's important to understand the delta, right? Because they're both connected. If we have a position on, let me see here. If we have a position on, buying the August 8th 1,200 call for $1.10, and we see the delta of it, well, where this position is going to make or lose, $12 up or down, it will make or lose, because it's an option times 100. So if you wanted to hedge just your directional risk, then you know what your directional risk is. You could hedge it because maybe you think the implied volatility is too low. You want to buy it, but you don't want to take that directional risk. So you could re-hedge your deltas every time the stock moves around in the hopes that, well, you're offsetting the directional risk. And if the implied volatility goes up, the value of the option will go down, will go up on a relative basis, or the other way around. So what you're doing is mitigating that directional risk by hedging your delta with the stock. All right. So you're isolating your risk to a certain risk sensitivity of the option, like say implied volatility. Then we have this gamma thing, and the gamma, why it's important is that delta is not constant. Okay, so your delta is not always constant. Like if you have a 12 delta, that doesn't mean this 12 delta is forever. That's not the sensitivity of the option forever. It changes. So your delta will change, and so will your gamma change based on other factors. Okay. And let's just look at an option chain and think about it. Why would it change? Like, why would my delta, like, why would the delta of this option, let's say 4% away, change? Like here, let's say, like, what are some of the, oh, sorry. So here's the delta, right? What was I looking? Let's say 1200. So the delta is 12 right now, right? So this option is expected to increase or decrease in value by 12 cents. But the stock, it's below here, right? The stock is 1,180, which is lower than 1,200. But if the stock keeps increasing and increasing and increasing, right, it could eventually even go above 1,200. It could go to 1,300. Well, that option becomes more in the money. And if it's more in the money, it's going to be more sensitive to a dollar move, right? It could be completely in the money. There'll be one delta. So as the stock is moving, your delta is going to change. Okay, your delta, the sensitivity of the option will change for a dollar move based on where the stock is relative to the strike. What if the stock goes all the way down? Well, if the stock goes down a lot, this option will start going towards zero. So the delta of it won't be 12 forever, right? It could be zero delta, where the option goes to a penny and it's not going to move around, from a penny to, it won't go higher unless the stock really has to come back. So that delta is changing based on how the stock moves. As it gets closer to the strike or above the strike, the delta is increasing. If it gets further away, it's decreasing. And that's what the gamma is measuring. So even if we start out with a 12, right? Even if we start out with a 12 gamma, well, if the stock moves higher and this option increases, the delta all of a sudden will increase, right? Because now it's more sensitive to a dollar move. The value of the option increased. It's closer to the strike. So this delta is going to start increasing. It's going to start getting closer to 1. The higher the stock goes in the call, the delta is increasing, getting closer to 1, especially if it goes, if it goes all the way through the strike and higher. But how do we know what the delta will increase by? Maybe it'll stay the same. Maybe it'll increase by 1. Maybe it'll increase by 2. Maybe is it going to go from 12 to 30, from 12 to 13, from 12? We can't, just looking at it, it's hard to say. And that's what the gamma is telling us. The gamma is telling us, well, if you start out at a delta of 12, if the stock moves up $1 and you have let's say, 0.01 gamma, then your delta is going to go from 12 to 13. If it goes down a dollar, it'll go from 12 to 11. So that's what the gamma is letting us know, is what is our delta going to change? We know what it is at this moment, but we need to know how much is it going to change for a dollar move. And for a single option, it might not be too significant, but if you're trading options, you probably have a big portfolio. You could have options here or there, or you have ratios. So that's where, the gamma helps. If you have like an option here, let's say you sold an option there, you sold an option here, you bought one here. Let's say you did it on ratios, here, 2 here, 5 over there. Well, how do I know what this portfolio is going to change? So we'd have to add them all up to see, oh, here's our delta for a dollar move. So that portfolio right now is saying this: if the stock moves up a dollar, it's estimated to make $164. And if it moves down a dollar, we're estimated to lose $164. Okay, that's our portfolio. Which if we wanted to hedge, we'd have to sell 164 shares of stock, right? Because sharing 164 shares of stock would hedge a dollar move, right? A dollar move down would make you 164. Dollar move up will lose you 164 in the stock, and this would be offset by the options. And the gamma is telling us, well, this 164 is not going to stay 164. If it moves up, it will increase by almost 9 deltas. If it moves down, it will decrease by 9 deltas. So if you did a hedge, if you did sell 164 shares of stock, if the stock moves up, you're expected to now be long 9 deltas that you would have to sell. If the stock moves down, you'd have to buy back 9 deltas. Okay, that's what the gamma is allowing us to measure and estimate. Okay. And always keep in mind, people are like, oh, is it exact? Option pricing models themselves are not. They're close. They're trying to get us close estimates, right? That's what we're trying to do, is hedge off close estimates. So we have this 9. Is it exactly 9? And it's dynamic. It's never going to be exact, but it shouldn't be 1,000 or negative whatever. It should be somewhere, if all our inputs are correct, it should be somewhere close to this, so we could hedge off and determine how much hedging we would need. So the other question is, well, why is my gamma changing if I move further in time, right? Like, why is my delta and gamma hedging? So think of it like this. Right now, this option, let's say I go to August 29th, just to make it easier, because now we added 16 trading days. Well, here's an option that has a 25 delta, but it's out of the money, right? So it's 1,235. So because it's out of the money right now, it has a sensitivity to a dollar move in the stock. But as we get closer and closer to expiration, if the stock doesn't move, right, if it just sits right here, this option will decay and get closer and closer to 0, right? So if it gets closer to 0, a dollar move won't make it move as much, right? Because it's going to be less days for it to go in the money. So we're losing these out of the money options are losing delta. The in the money options are going to be increasing because the premium is decreasing and it's acting more like 1-to-1. So looking out in the money, you could start out at 25 delta. And as passage of time goes on, let's say nothing else happens except passage of time. We go from 16 days to 1 day, right? So you can see here, this 12, let's even look at it. Here's which one was I looking at? 1,235 strike. Right now it has a 25 delta, but if we go to August 8th, right, now we have 1 day, the 1,235 strike has a 1 delta. So you can see now this option is worth less, same strike, it's worth less, and it's less sensitive to a dollar move. It's getting closer to zero. So that's why our delta is changing. But if the delta is changing, so is our gamma, right? So the gamma, is no longer, we're not going to go from one delta, to 100 or to 30 for a dollar move in a stock anymore. If this option gains, a penny, that's probably like, where we're at, gain or lose a penny, but it's less sensitive, right? The delta itself is less sensitive now than a further out option. And that's why our gammas change, right? The rate of the delta now is changing as well. So what we saw was, really quickly, without changing implied volatility, by the way, all we did was say changing in stock price, changing in passage of time impacts our gamma, impacts our delta, right? That's how the options work. And on top of that, implied volatility will change your delta and gamma. Interest rates or cost of carry assumptions will change your delta and gamma. And this is why we use these option pricing models to help assess or give us a sense of what type of risk are we looking at in our portfolio, and making those decisions how to mitigate unwanted risk, right? If you don't want let's say you want to hedge off the directional risk, right? Because you still have implied volatility risk, vega risk. If you want to hedge off that and mitigate that directional risk, you have a sense of how much you need to hedge. Well, I'm going to stop there. I think I covered from my memory the questions raised.
Yeah, actually, Jim, who's on and asked the question, he says, "Thank you, D. I have a better understanding of gamma impact in a trade now. Thank you." All right, great job,
thank
D.
you. All right, thank you for the question. Everyone stay safe out there. Have a great weekend. Have a great trading day, and we hope to see you guys on Monday.
It is the weekend, everyone. All right, thanks, Steve. We'll see you Monday, buddy. Thank you so much.
Bye, everyone.
Bye. All right, everyone. Thanks for joining us for another webinar brought to you by Dimitri. Great question, Jim. Thanks for bringing it. Everyone, remember to follow us on all the social platforms. If you're on YouTube right now, remember thumbs up and follow us if possible. Everyone, have a great trading day. It's a great weekend, and we will see you Monday. Have a great day.